Hello everyone. Good afternoon, students. Okay, so let's start with our today's lecture. I hope you all are doing good. Okay, so today we'll be starting with the practical problems. So we have completed all our ratios till now. Okay, and now we are going to start with our practical problems. But before we are going to start with the practical problems, quickly we will just revise these ratios. Okay, and then we'll be starting with the practical problems, okay, so that you all don't face any problem while solving the questions. Fine. So let us now start first with the revision of the ratios which we have done. Okay, first of all, my dear students, as we have discussed, that ratio is nothing but what? It's a relationship between two or more variables to arrive at a meaningful result. Okay, now when we are talking about ratios, there are three main types of ratios. The first type of a ratio which we had was called as a balance sheet ratio. The second type of a ratio which we had was called as P&L ratio. And the third type was your mixed ratios. And then we also did some other important ratios. Okay. So balance sheet ratios, as we have discussed, the numerator and denominator both comes from your balance sheet. All right. So these are also known as your solvency ratios. They are always calculated in pure numbers, like something is to one, something is to one, you know, they're always calculated in pure numbers. So these particular ratios, how are we going to calculate, and what are the types of these ratios? So my dear students, basically we have seven types of balance sheet ratios. What are the seven types of balance sheet ratios? The first one which we have is called as your current ratio. Then we have quick ratio. Then we have super quick ratio. Okay. Now, in current ratio, my dear students, your numerator and denominator, your both comes from your balance sheet. The formula for that was current assets upon current liabilities. The standard ratio for that was 2 is to 1. Correct? If this ratio is higher, then we will always say that it is better for the particular company, because higher the current ratio, better it is. But then I also explained you one disadvantage for the same. If this ratio is extremely high, then can I say there is inefficiency in utilization of the funds? Come on, yes or no? Yes, sir. And the standard ratio for that was 2 is to 1. Quick ratio, we had quick assets upon quick liabilities. In your quick assets, we took current assets, and from that we subtracted two types of non-quick assets. So what are the two types of non-quick assets which we subtracted? Number one was your stock, and number two was your prepaid expenses. Okay, so both these things we used to subtract it, and we used to divide that by current liabilities. The standard ratio for that was 1 is to 1. After that, we had something which was called as your super quick ratio. And in super quick ratio, we always took cash, bank, and marketable securities, and we divided that by our current liabilities, which indicated how much cash or near cash which we have to repay 1 rupee of current liability. Then, my dear students, we discussed something with regards to your stock to working capital ratio. Stock to working capital ratio, this helped you to understand that what is the amount of the stock which is blocked in the form of working capital, right? So the formula for that was what? Current assets minus current liabilities. Your working capital formula was current assets minus current liabilities. And then we checked what is the amount of the stock which is being blocked. Okay. So on that basis, we come to know that what is your stock to working capital ratio. Then we had something which is called as a debt to equity ratio, where we took long-term debt and we divided that by equity shareholders funds. If this ratio is lower, it means that the risk in the company is also lower. And my dear students, if this ratio is higher, it means that the company is exposing itself to more financial risk and financial leverage. Okay. So that is why debt to equity ratio, we always took long-term debt and we divided that by equity shareholders funds. Okay. So equity shareholders funds had equity share capital plus reserves and surplus, and from that we subtracted miscellaneous expenditure not returned. Okay. Then my dear students, we also discussed something with regards to your capital gearing ratio. Again, the same concept. Capital gearing ratio, we took whatever is the fixed commitment and from that we divided your non-fixed commitment. So if this ratio is extremely high, it means risk is also high. If this ratio is lower, it means risk is lower, because we need to check that what is the fixed commitment, you know, against the non-fixed commitment. If the fixed commitment is too much high, then can I say it can result to big obligations for the company? Yes or no? Yes, sir. And then, my dear students, we had something which was called as your proprietary ratio, where we took proprietors funds and we divided that by your total assets. If this ratio is higher, then it means that the stability is also higher. And I also explained you there was a difference between proprietor as well as your shareholders. Okay, shareholders as well as your equity shareholders. Because in your shareholders, are we going to consider your preference shares as well? Come on, yes or no? Yes, sir. But in equity shareholders funds, we don't consider your preferential capital. Then, my dear students, we discuss something with regards to your P&L ratio. In your P&L ratio, numerator, denominator, both comes from your P&L. And there we discussed GP ratio, then we discussed net profit ratio, then we discussed operating profit ratio. Then, my dear students, we discussed your admin expense ratio, after which we discussed selling and expense ratio or sales promotion expense ratio. Then after that, we had operating expense ratio, and towards the last, I also taught you operating ratio. Okay. So gross profit ratio always as a percentage of sales. How do you calculate that? Gross profit upon sales into 100. Net profit ratio is always a percentage of sales. We take NPAT and we divide that by sales into 100. Operating profit ratio, I explained you via income statement. We took EBIT and EBIT divided by sales into 100. Then admin expense ratio, we took admin expense upon sales into 100. Selling and distribution expense ratio, we can take selling and distribution expenses upon sales into 100. Operating expense ratio, so those list of operating expenses will be given to you. We can divide that by sales into 100. And then we had operating ratio. So 1 minus operating profit ratio used to give you your operating ratio. And guys, all these ratios should be lower the better. And the profitability ratio should always be higher the better. So we had discussed that as well. Then, my dear students, we discussed something with regards to your mixed ratios. And mixed ratios also had two main types of ratios. First, it was called as turnover ratios, and the second one, it was called as your return ratios. And in turnover ratios, we discussed what is capital employed turnover ratio, where we compared the sales with the capital employed, right? So we wanted to check that with 1 rupee of your capital employed, how much is the sales which is getting generated. So we took sales and we divided that by your capital employed. And always remember that this ratio should be higher the better. Okay. Then, my dear students, we discussed something with regards to your fixed assets turnover ratio. Again, the same concept. Sales, we divided that by your average fixed assets. Okay. Then we had something which was called as working capital turnover ratio. With 1 rupee of working capital, how much sales is getting generated? And I explained this to you earlier also. In case of mixed ratios, what we need to do? We have to take in the denominator the average part. Can you recollect this? Because your numerator was coming from P&L, your denominator was coming from the balance sheet. So based on that, in our last lecture, we discussed that we have to eliminate the timing difference. And we can eliminate the timing difference with the help of average. Come on, yes or no? Answer is yes, sir. So that was capital employed turnover ratio, fixed assets turnover ratio, working capital turnover ratio. Then, my dear students, we had stock turnover ratio, which actually help you to understand how many number of times in a year the stock is getting rotated in the business. For that, we had COGS and we divided that by average stock, right? Which should also be higher the better. But with the help of stock turnover ratio, we understood that we can also calculate your stock holding period. So then, my dear students, stock holding period. So if your stock turnover ratio is 6 times, it means that the money which is getting blocked in the form of stock is for the period of 2 months. If your stock turnover ratio is 12 times, it means that money which is getting blocked, that is for the period of 1 month. So always remember that your stock holding period is calculated by taking into consideration whatever is going to be your COGS, your 1252 or 365, and we divide that by your stock turnover ratio. So that is actually going to give you your stock holding period. Then we had something which was called as debtors turnover ratio. This indicated what are the number of times in a year the debtors are giving you the payment. Okay. Then we understood debt collection period. Then, my dear students, we had same creditors turnover ratio, and then the last one was your creditors payment period. So capital employed turnover ratio should always be higher the better, because we want the sales to be generated for more and more times with 1 rupee of the capital which we are employing it. Fixed assets turnover ratio. This should also be higher the better, because we always want your fixed assets, your sales to be for more number of times as compared to 1 rupee of the fixed asset. Working capital turnover ratio, you want your sales to be for more number of times for 1 rupee of the working capital. Then we had stock turnover ratio. This also we want higher the better, because we always want the stock to be rotated in the business for more number of times in a year. Stock holding period should always be lower the better. Why, students? Because if the stock holding period is lower, what does it indicate? That the money which is getting blocked in the stock is for lesser period of time, and that is to be considered good for you. Then we had something which was called as debtors turnover ratio. Debtors turnover ratio should also be higher the better, because we want the debtors to be liquidated and converted into cash as fast as possible. Then, my dear students, we had debt collection period. This should be lower the better, because an efficient receivable management department, what they will try and do, they will always try and keep the debt collection period as low as possible, so that money which is getting blocked in the customers, that is as low as possible, so that the turnover becomes faster. Then we had creditors turnover ratio. Creditors turnover ratio, my dear student, should be always lower better, because when it comes to making the payment, we always want the creditors turnover ratio to be as low as possible. Okay, because we want to make the payment as slow as possible. So for that, your creditors payment period should always be higher. Then, my dear students, we got something which was called as return ratios, and we discussed your 4 returns. First, we discussed return on equity shareholders funds. Then we discussed return on shareholder funds. Then we discussed return on capital employed. And then we also discussed return on capital employed, but that was post-tax. Right? Can you all recollect this? Okay. So when we are talking about, my dear students, return on equity shareholders funds, okay, this is just a revision which I want to do before we start with the practical problems. So whenever we are talking about return on equity shareholders funds, we always divide that with what? We divide that by the average equity shareholders funds. And if average is not given to you, then closing equity shareholders funds. For return on shareholders funds, we will always divide that by shareholders funds. For return on capital employed, we will always divide that by capital employed. Okay, and same for post-tax, we will divide that by capital employed. Now, in the numerator, what should you take? So for equity shareholders fund, we will always take net profits available for equity shareholders. For shareholders funds, we will always take NPAT, right? Because that's the money which is available for all the shareholders. For capital employed, we used to always take EBIT, and for post-tax, we used to convert that into post-tax. It was EBIT into 1 minus tax. So all these things should be forming part of your mixed ratios. And then we have some other important ratios. So in some other important ratios, we discussed something which was called as your earning per share. Then what was earning per share? Whatever was the earnings for equity shareholders, we divided that by your number of equity shares. So that gave you your earning per share, and which should always be higher, right? Then we had discussed dividend per share. Again, the same concept. Whatever is the equity dividend, we divide that by number of equity shares. Then, my dear students, we have something which was called as your retention ratio. So guys, if your EPS is 10 rupees, dividend paid is 4 rupees, so your retention is 6 rupees, right? Then we have something which was called as your dividend payout ratio, where if your dividend paid out is 5 rupees on the earning per share of 10 rupees, then the payout ratio is said to be 50%. Then, my dear students, after doing all these things, we have something which is called as your book value per share, which was equity shareholders funds, divide that by number of equity shares. If you can recollect, we had discussed that yesterday, that if I give you a dairy milk silk, and if suppose at home you have 4 or 5 people which are there, so then you have to distribute that on per share basis. Okay. Then there is something which is called as P ratio, which is MPS upon EPS, which is an indicator of demand. How much is the willingness of equity shareholder to pay for 1 rupee of EPS? Then, my dear students, we discussed something which was called as your coverage ratios, right? So we had coverage ratios called as your interest coverage ratio, then your preference dividend coverage ratio, and your equity dividend coverage ratio. In all these coverage ratios, it was a very simple concept that how are we making the payment from the same. So basically, for example, if I tell you that EBIT is 1 lakh, from that I'm paying the interest of 10,000. Then my interest is getting covered 10 times. So that's why the interest coverage ratio is EBIT upon interest. Preference dividend coverage ratio, from where do we pay that? We always pay that from your NPAT. So we take NPAT and we divide that by preference dividend. For equity dividend coverage ratio, we take whatever is the net profits available for equity shareholders and we divide that by equity dividend. So all these ratios we had covered. All the coverage ratios should be higher the better. P ratio higher, indicating more demand. Book value per share application was when we used to compare that with the market price per share. And then we had EPS, DPS, retention and dividend payout ratio. Okay. So all these things we had discussed. Now, my dear students, all the ratios are revised. Okay. Now we'll be starting with the practical questions. Now see how beautifully you'll be able to solve all the practical problems. I want you all to keep your notebooks handy. Keep your calcs with you. Prepare and solve this and all the questions along with me. Okay. So we are going to study this in the most conventional method. Okay. Which is whether you are watching this recorded live from the course, wherever. Our objective is very, very, very simple. We are going to study in, like just as we are studying in a classroom. So properly notes management, some solving, writing down the page numbers in your notebooks, I would always recommend you to do that. So you can give page numbers to your notebooks. Okay. And then whatever questions you are solving, just give the reference to the page number on which page number the solutions are there. Each and every question will be solving step by step in the institute's most comprehensive manner. Okay. Because always remember our target is to get 50 on 15 FM. Okay. And I am going to put all my efforts there. I want you also to put all your efforts. Okay. Go all in for this particular part. Okay. Chalo. Now let us start with your first question. Question number 1. The following is the balance sheet of Z Limited on 31st of March 2020 and the other information from which you are required to calculate the following ratios. So which ratios you have to calculate, beta? We are required to calculate your current ratio, liquid ratio. Liquid ratio is also known as your quick ratio. And guys, this is also known as your asset test ratio, whatever. Then we are required to calculate stock to working capital ratio. Then we have to find out capital gearing ratio, stock turnover ratio, debtors turnover ratio, and collection period. And then, my dear students, we have stock on 1st of April 2019 was 1,20,000. Obviously, this is nothing but your opening stock. Okay. And then sales all credit were rupees 20 lakhs. Okay. Gross profit on sales was 25% and debtors on 1st of April were rupees 40,000. So we have opening debtors as well. And as you all can check, we have balance sheet as on 31st March 2020, in which we have 12% preference share capital, equity share capital, we have capital reserve, general reserve, P&L account, 14% debentures, creditors, bank overdraft, and on the asset side, we have fixed assets, short-term investments, stock, debtors, and prepaid expenses. Now, my dear students, isn't this evident? Just by looking at the balance sheet, you can very well identify that there are certain assets which are current in nature and there are certain liabilities which are current in nature. Now, what are these current assets and current liabilities? Just check. Can I say there is short-term investments? Yes, short-term investments is your current asset. Stock, is it your current assets? Yes. Debtors, is it your current assets? Yes. Prepaid expenses, current assets? Yes. All these are your current assets. Fixed assets is not your current assets, sir, because they are always procured with an intention that we are going to keep it for at least 1 year. Okay. Then on the liability side, we have creditors, that's your current liability. We have bank overdraft, that is current liability. Okay. And my dear students, these are the different sources of funds from which we have raised the capital. Okay. 14% debentures. Of course, it is always raised from the perspective of long-term repayment obligation. So that's why it's always a long-term. Okay. And all these are your reserves, equity, and preferences is given to you. Okay. Now, whenever you see preferences in the particular question, can I put it like this? That in this question, your shareholders funds and your equity shareholders funds, they both are not the same. Can I say your shareholders funds are different from your equity shareholders funds? Come on, yes or no? Of course, yes. So in this particular question, your shareholders funds and your equity shareholders funds, they are not the same, because equity shareholders funds only and only deals with what? It deals with equity share capital plus reserves and surplus minus miscellaneous expenditure not written off. And shareholders funds will be equity shareholders funds, and along with that we will add preference share capital to it. So in this question, do we have preference share capital? Come on, yes or no? Yes sir, we do have it. Okay. Now, based on this, let us now start with the different types of ratios. So I just want you all to please go to your notebooks and write down solution now to question number 1. How should we approach? The first ratio which we are going to do is your current ratio. Okay. So now we will start with A part, current ratio. Now in this current ratio, first step is we will always write down the formula. So what's the formula? Current assets and to this we will divide current liabilities. So our current ratio is current assets upon current liabilities. Now, have we identified the list of current assets? Come on, yes or no? Yes, we have identified. What are the list of current assets which we have identified? Then we have something which is called as short-term investments. So now we have to write down the breakup of that. We have short-term investments. Then we have the next thing, which is your stock, debtors, and prepaid expenses. So we have stock, we have debtors, and then we have prepaid expenses. And then, my dear students, in your current liabilities, what do we have? So we have creditors and bank overdraft. We have creditors and then we have bank overdraft. Okay. Now, do we have the amounts also available? Come on, yes or no? Yes, sir. What is the amount of short-term investments? 2 lakh. To this we will add 3 lakh 80. Then we will add 3 lakh 60. Right. To this we will add 60,000. And then, my dear students, we need to divide this with your creditors. So what's your creditors? 3 lakh 20. And this one is 80,000. Okay. So now, my dear students, what will be the total of this? So these are the steps which we have to follow. You just can't write down current asset upon current liability normally, only this upon this. We have to write down the formula. We have to show them the breakup. We have to write down the amounts also. And then we will do the total of this. So this will now be 10 lakhs. And to this 10 lakhs, I will need to add 4 lakhs. So this will now give me 2.5:1. So what does this indicate, guys? For every 1 rupee of current liability, do we have 2.5 rupees of current assets? Come on, yes or no? Yes, sir. So for every 1 rupee of current liability, we have 2.5 rupees of your current assets. Okay, so this was your first ratio. Now let's start with the second ratio. So systematically, we have to do it one step at a time. This is how our presentation should be. We should not give even a single chance to the examiner to cut our marks. Okay. It should be presented in the best possible way. What's the B part? Quick ratio. So again, in your quick ratio, what is the formula? So we have quick assets upon quick liabilities, but you all know what are quick assets. From the current assets, what do we subtract, guys? From the current assets, we need to subtract stock, and then we need to subtract your prepaid expenses. And then, my dear students, we have to divide this with your current liabilities. Guys, do we have to subtract bank overdraft? Then the answer is no. If the question specifically tells you to subtract bank overdraft, then the answer is yes. Then we need to subtract it. Okay. Or else there is no need to subtract the bank overdraft. Do we have the total of the current assets? Yes, sir. We do have the total of current asset, which appears to be 10 lakhs. And then from 10 lakhs, we need to subtract stock. Now, what's the amount of the stock? Just check. It's 3 lakh 80. So 10 lakh minus 3 lakh 80 minus what's the amount of the prepaid expenses? So prepaid expenses is 60,000. So now I will subtract 60,000. And then we will divide this with your current liabilities. So do you have the amount of the current liabilities? Yes, sir. That is 4 lakhs. Now, what is the total year? So 10 lakh minus 3 lakh 80 minus 60. So this is 5 lakh 60. And from 5 lakh 60, I need to subtract 4 lakhs. So this will now give me 1.4:1. So this is how your quick ratio will be calculated. For 1 rupee of your current liability, my dear students, we have 1.4 of your current assets. Okay. I hope you all have understood till now. Okay. Now, after this, what is the next ratio which we have? So your third ratio is your stock to working capital ratio. Okay, no problem. So we can calculate your stock to working capital ratio. And how will we do this? So your stock to working capital ratio basically will have your closing stock, which we need to divide that by working capital. Okay. And guys, working capital, as you all know, it is CA minus CL, because this ratio will tell you that on 1 rupee of working capital, how much is blocked in the form of stock. Okay. So what's the amount of the closing stock, guys? Let's start. Your amount of the closing stock is nothing but 3,80,000. Okay. And guys, what's the amount of the working capital? So your working capital is CA minus CL. So we have the list of the current assets available. So that was nothing but 10 lakhs. And from that, we'll subtract current liability, which is 4 lakhs. So this will eventually become 6 lakhs. So from 3 lakh 80, now if I'll subtract 6 lakhs, so this will now be 0.63:1. So this is going to be your third ratio, 0.63:1. Okay. Then what is your fourth ratio? Your D part. Your D part will be capital gearing ratio. So we have something which is called as capital gearing ratio. So guys, can I say your capital gearing ratio will always have fixed commitment upon non-fixed commitment? So we have fixed commitment. So what are the fixed commitments which we have? We have 12% preference shares plus what is the other fixed commitment which we have? Can I say if there is 14% debentures? Okay, both of them are your fixed commitment sources, right? Because we have to compulsory pay them. They are fixed commitment. So fixed commitment sources is debt and preferences because their rate is fixed. So we have to compulsory make the payment based on their respective rates. Okay. And we need to divide this with what? We have to divide this with your equity shareholders funds. So I will now divide this by my equity shareholders funds. And what is my equity shareholders funds? Equity share capital plus reserves and surplus. From this, I will subtract miscellaneous expenditure not written off. Okay. So what is your preference share capital? So let's now figure this out. Your 12% preference share capital. What is the amount? 3 lakhs. Okay, no problem. Then what is your 14% debentures? So as you all can check, it's 1 lakh 60. And I need to divide this with what? Equity shareholders funds. So can I say my equity shareholders funds is the combination of equity share capital, which is 6 lakh 40, plus reserves and surplus. So I need to take the total of all these reserves and surplus. So which is 2 lakh 80,000, right? Because there is capital reserve, general reserve, P&L. And there is no miscellaneous expenditure to the extent not written off. Okay. So then this will be 6 lakh 40 plus 2 lakh 80. So eventually this is going to be what? 9 lakh 20. So we have our fixed commitment sources, which is 4 lakh 60. I will divide that by 9 lakh 20. So eventually this will be 0.5 is to 1. Okay. So are you all convinced with this much part? We have this as 0.5 is to 1. This is your capital gearing ratio. Okay. Now, my dear students, the next ratio which we have is your stock turnover ratio. Stock turnover ratio. My dear students, I told you that in stock turnover ratio, we have to focus on COGS. If COGS is available, then we will use COGS upon average stock to calculate your stock turnover ratio. But yes, if COGS is not available, then we are going to use sales for the purpose of calculation. But in this particular question, do we have the COGS available? Come on, yes or no? Yes, sir, we can calculate the same because we have the GP margin available. So that's why my stock turnover ratio will be COGS upon average stock. Okay, COGS upon average stock. So my dear students, how will you calculate your COGS? Of course, this is nothing but sales minus GP. And guys, what's your average stock? So that is your opening plus closing divided by 2. Right? That's going to be your average stock. So your sales, my dear students, is appearing as how much? Just check. So your sales available with you is nothing but 20 lakhs and GP is 25% on sales. So we have this as 20 lakhs. And from sales, we can directly subtract the GP percentage, which is 25%. So sales minus GP. Okay. GP, as I told you earlier also, it's always a percentage on sales. So from 20 lakhs, if I subtract 25%, that will give me my COGS. And do I have the opening stock available? Yes, sir. I do have the opening stock. What's the amount of the opening stock? 1 lakh 20. What's the amount of the closing stock? 3 lakh 80. So it's going to be 1 lakh 20 plus 3 lakh 80, which I need to divide it by 2. 1 lakh 20 plus 3 lakh 80, divide that by 2. So this is 2 lakh 50,000. So from 20 lakhs, I need to subtract 25% and divide that by 2 lakh 50. So this ratio is coming as 6 times. Now what does this 6 times means? Guys, this 6 times means that this particular stock is getting rotated for 6 times in a year. It is getting rotated for how many times in a year, beta? It is getting rotated for 6 times in a year. For 6 times in a year, there is rolling for this particular stock. So we have the stock turnover ratio 6 times. So obviously, if I ask you what is the stock holding period, then what will be your answer for the same? So sir, in that particular case, your stock holding period will be 12. I divide that by 6 times. Can I say it will be 2 months? Come on, yes or no? Absolutely yes, sir. So from 12, you divide that by 6 times, we'll be getting 2 months. That's going to be your stock holding period. So I hope you guys are trying to understand that whenever we are required to calculate the stock turnover ratio, we can calculate the stock turnover ratio like this. If they ask you to calculate the stock holding period also, we can have a judgment of 12, 52 or 365. Divide that by your stock turnover ratio. That will give you stock holding period. And again, my dear students, we will always want the stock turnover ratio to be lower the better or higher the better. Of course, higher the better. Because higher the stock turnover ratio, better it is. It means that your stock holding period is lower. Okay. Systematically, step by step, this is going to be the presentation. Okay. You might feel, okay, sir, do it a little fast. No. But every particular question, every part of the question, if you are seeing the video and solving it, it will help you to practice in so much of detail. Okay. And all these things are going to be fixed in your mind very, very, very thoroughly. So once you do it with me, once you revise it and then you prepare for your examinations, that is going to be your ultimate approach for your financial management. And I'm telling you that is going to be more than sufficient. Okay. So this was your E part. Now let's do it for F part. And then your next part is going to be debtors turnover ratio and collection period. How will you calculate your debtors turnover ratio? Guys, can I say that the debtors turnover ratio is credit sales upon average debtors? Credit sales upon average debtors. So do you have your credit sales? Come on, yes or no? Yes, sir. What's the amount of the credit sales? 20 lakhs. What is your average debtors? Can I say again same opening plus closing, divide that by 2. So do you have opening debtors? Yes, sir, 40,000. Do we have closing debtors? Yes, sir. Closing debtors is 3 lakh 60. And we will divide that by 2. So this will now be 20 lakhs. Divide that by 2 lakhs. So this will be nothing but 10 times. 10 times. So this will be your debtors turnover ratio. And guys, once we have the debtors turnover ratio, can we very easily calculate your debt collection period also? Come on, yes or no? Yes, sir. What's your debt collection period? So your debt collection period will be 50 to 12 or 365, right? I simply have to divide that by the debtors turnover ratio. Now, what should I take? Should I take 52 weeks, 365 days, or what? So, or 12 months. So, Institute tells you that if no data is given to you, then we will always calculate the collection period in days. And when we are calculating this in days, so we have to take 365 days until unless specifically given to you. And there is no need to worry about leap year or something like that. We simply have to take 365 and divide that by your debtors turnover ratio. So I will take 365 and divide that by the debtors turnover ratio. So we will calculate this in days, 365 upon 10 times. So this will now be 36.5. So approximately 37 days. So this will be your debt collection period. Now you must be wondering, okay, sir, what if it's 36.3? So Institute rounds this days as we are rounding it off in terms of, normal rupee calculation. If it is 0.5 or more than 0.5, then next day. If it is less than 0.5, then the previous day. Okay. Practically, I know this is not possible. 36.3 is also 37th day only. But Institute rounds off the days based on this normal concept. Okay, if it is less than 0.5, then on the previous day. If it is 0.5 or more, then it will be on the next day. Okay, so this is what we are going to do. So guys, we have now completed our very first question. All the ratios are now done. I hope you have understood this. What is going to be the process of solving? Okay. First, read the question, identify what are current assets, current liabilities. Then each and every ratio very carefully. First, we'll write down what the ratio is, what are the ingredients of the ratios, what are the figures involved, totality, and then we'll be finding out the ratio. So there are no shortcuts to success. Okay. We just can't do it directly. We have to do it in this particular process with this presentation. Okay. Now let us start with your next question. Okay. So I want you all to please come to your question number 2. Let's read this. In a meeting held at Solon, so there is a place called as Solon, towards the end of 2016, the directors of Messrs. HPCL have taken a decision to diversify. At present, HPCL sells all the finished goods from its own warehouse. The company issued debentures on 1st of Jan 2017 and purchased the fixed assets on the same very day. The purchase prices have remained stable during the concerned period, and following information is provided to you. So we have income statements for 2 years, that is 2016 and 2017, where we have cash sales, we have credit sales, then we have less cost of goods sold, gross profit, less operating expenses, then we have warehousing, transport, admin, selling, interest, then we have for net profits. We also have the balance sheet available in which there is fixed assets, net block, which is 30 lakhs, 30,000 and 40,000. So what is net block? Net block means the gross amount of the fixed assets minus the depreciation provided on it. So that will give you the net amount. Okay. So they have directly given to us the net amount. That is after the provision for depreciation or accumulated depreciation charged on it. Then we have receivables, which are also known as the debtors. We have cash at bank. We have stock. Then after that, we have total current assets. Then we have payables. Then there is total current liabilities. Working capital. In working capital, we that is CA minus CL, after which we have total assets, which is represented by share capital, reserves, and surplus and debentures. You are required to calculate the ratios for the years 2016-2017. So my dear students, in this particular question, we are required to calculate the ratios for 2 years. So we are required to calculate the ratios for 2016 also and for the year 2017 also. Okay. Ratios relating to capital employed should be based at the on the capital at the end of the year. Okay, so this statement is important. So whenever we are calculating the ratios which is based on the capital involved, so then that should be always on the closing capital. So there is no need to take any average on the same. Okay, so you all can just check here. We are taking capital turnover ratio. So what is your capital employed turnover ratio? So capital employed turnover ratio will be your sales upon average capital. But they have told you that we should take this into consideration by considering only the capital at the end of the year. Give reasons for the changes in the ratios of 2 years, assuming that the opening stock of rupees 40,000 for the year 2016. So we have the opening stock for the year 2016 and we have to ignore the tax. So my dear students, in this entire question which we have read, we are required to calculate the ratios which I just told you. Okay. And these ratios which we need to calculate it, for that, first what we will do is we have to prepare two columns for the year 2016, for the year 2017, and then the ratios we need to calculate it. Substitute the figures and get the answers. Okay. So go to your notebooks and now write down. This is solution to question number 2. Calculation of ratios for 2016 and 2017. So now we'll be taking particulars. There will be 2016. There will be 2017. Okay. Now, what is the first ratio? The first ratio which we need to solve is your gross profit ratio. Everything in detail systematically, the way you are learning in the class, properly, one step at a time. Okay, so this is going to be our approach. What is your gross profit ratio? The formula for this is gross profit upon sales into 100. So guys, do you have the amount of the gross profit? Come on, yes or no? Yes, sir, we have the amount of the gross profit. So the gross profit for the year 2016 is nothing but 64,000. So this is the gross profit which we have. Okay. For the year 2017, we have a gross profit of 76,000. And what is going to be the amount of the sales? So you have the sales, which is nothing but 3 lakh rupees here and 3,74,000 here. So based on this, 64,000 divided by 3 lakhs into 100. So this will now be 21.33%. And then this is 76,000 divided by 3,74,000 into 100. So this is 20.32%. So these are your two gross profit ratios, 21.33% and 20.32%. Okay. First ratio, I hope you all have completed. This is coming as 21.33% and 20.32%. What's your second ratio? Your second ratio, which we have, is called as your operating expenses to sales ratio. Operating expense to sales. Guys, as we have already discussed, operating expense to sales ratio, what will be this ratio? We have to take the list of operating expenses, we have to divide that by sales. Okay. So we will take operating expenses and we will divide that by sales and multiply it by 100. So do you have the list of operating expenses? Yes, sir. We have it here. List of operating expenses, which is nothing but, you all can just check. There is warehouse, transport, admin, and selling. The total of this is 49,000. So anything which is excluding your interest element. Okay, so this is nothing but 49,000. And here we have this operating expenses. Guys, as you all know that interest is not going to be your operating expense. Interest is your financial expenditure. Okay. So we have to take into consideration 14, 10, 19 and 14. So we will now take 14 plus 10 plus 19 plus 14. So that is 57,000. And my dear students, we have to divide this by amount of credit sales or no, total sales, because it's operating expense to sales. So do we have the total sales? Yes, 3 lakhs and 3,74,000. So this will be 3 lakhs and this will be 3,74,000. So this data is sufficient for you. 49,000, divide that by 3 lakhs into 100. So this will be 16.33%. And this one is 57,000 plus 3,74,000 into 100. So this will now be 15.24%. I hope you all are getting the same answers. So this is 16.33 and your 15.24%. 16.33 and your 15.24%. Okay, students. Now, after this, which one is your third ratio? So, guys, your third ratio is gonna be operating profit ratio. So as I told you, when we are talking about operating profits, we always deal with your amount of EBIT and we divide that by sales. Okay. So now we'll be taking into consideration your EBIT, divide that by sales and multiply it by 100. So what's the amount of EBIT? Just check the amount of EBIT, guys. Earnings before interest and tax. It means tax should not be subtracted and interest should not be subtracted. Now in this particular, you all can just check. They have told us to ignore tax. So there is nothing we have to worry about. But guys, do we have the net profits available, which is 15,000? Come on, yes or no? Yes, sir. The net profits is 15,000. But in this 15,000, you don't have to worry because tax is anyway ignored. And for the year 2016, there is no interest also. So if there is no interest, can I say this 15,000 itself is nothing but your EBIT for 2016, not for 2017? Because in 2017, you all can just check that your net profit is 17,000, but that is after subtracting interest. But we want the profits before we have subtracted interest. So what should I do? Can I add back the amount of the interest? Come on, yes or no? Yes, sir. So in that particular case, my EBIT will be nothing but 19,000. Simple concept. Okay. So whenever, my dear students, we are required to calculate this. So what is going to be our EBIT for the very first year, for the year 2016? So my EBIT for 2016 is going to be 15,000 only. Okay, because there is no interest. Okay, so whatever is your NPAT, to that if I add the amount of the interest, so the interest amount is 0. So this has to be 15,000 itself. But my dear students, whenever I'm talking about 2017, in 2017, I have my net profits of 17,000. So to this 17,000, I will add 2,000. So this will now be 19,000. And then I need to divide this by sales. So do I have the amount of the sales? Yes, sir. I have the amount of the sales, which is 3 lakhs and 3,74,000. Multiply this by 100. So this data is sufficient for you to calculate what is going to be your operating profit ratio. So this is going to be 5%. 5.08%. This will be your operating profit ratio. Very simple to calculate, guys. Okay, so EBIT, divide that by sales into 100. And whenever we are calculating EBIT, what do I have to take? I have to take your EBIT and to that I have to add the amount of the interest. So that will give you 19,000. Okay. Fourth part. What is your fourth part? Your fourth part is capital turnover ratio. So guys, how do you calculate your capital turnover ratio? Your capital turnover ratio is nothing but sales upon, we usually write down average capital employed. Correct? But my dear students, I'm not going to write down average. Here I'm going to take closing. Acha, why I'm going to take closing is because they have specifically told you that we have to take closing. Whatever is the ratios with regards to your capital, we have to consider closing. And anyway, can I tell you something? This has to be closing only. You know why this has to be closing? Because for the very first year, see, for the second year, definitely you have opening and closing both. See, just check. For the year 2017, do I have closing capital employed? Yes, sir. That is 1,47,000. Do I have opening capital employed? Yes, sir. That is 1 lakh. So we have closing and opening both available. So we can very well do average. But for the year 2016, do you have the opening capital employed? The answer is no. You don't have any opening capital. So for 2016, anyway, I will be using closing capital employed. So for standard measures of comparison, for 2017 also, I have to take closing capital employed. Both the cases, I have to take closing capital employed. Okay. So for 2016 also, I should take closing capital employed. For 2017 also, I should take closing capital employed. Okay. Though they have specified it, but I'm just telling it to you that whenever, for if the ratios are required to be calculated for 2 years and for first year, if opening is not available, then we'll definitely take closing. For the second year, though the opening is available, but still we are going to take into consideration closing only. We are not going to consider average. Why? Because we want standard measures of comparison. So that's why we are not going to take opening. We are going to take closing only for both the years. Okay, so this is something for which I'll give you a note towards the end. But I hope you have understood this part, that in your capital employed, we have to take closing capital employed. So you'll not make this mistake even in the examination, because they have told you that we are required to calculate on the basis of closing itself. So do you have, first of all, the amount of the sales? Come on, yes or no? Yes, sir. We have the amount of the sales, which is 3 lakhs and 3,74,000. So we have this as 3 lakhs and 3,74,000. And we have to divide that by your closing capital employed. So what's your capital employed? Can I say your capital employed is nothing but share capital plus reserves and surplus plus debentures. So that together forms your capital employed. So capital employed means total amount invested in the business, and this total amount which is getting invested in the business, that is from your shareholders funds, equity shareholders funds, also from your debt or debentures or long-term loan or whatever. So that together constitutes your total capital which is being employed. Okay. So my total capital employed will be 1 lakh, and here your total capital employed will be 1,47,000. So this will be 3 times, and this will now be 3,74,000 divided by 1,47,000. So this will be nothing but 2.54 times. So this is your capital employed turnover ratio, or your capital turnover ratio, which is 3 times and 2.54 times. Then, my dear students, we have something which is called as fifth part, fifth ratio, which is your stock turnover ratio. Okay, stock turnover ratio, guys, as you all know, what's the formula for stock turnover ratio? That is nothing but your COGS, which we divided by average stock. So do we have your COGS available? Come on, yes or no? Yes, sir, we do have the COGS available. What's the COGS? Just check. We have the COGS available of 2,36,000 and 2,98,000. 2,36,000 and 2,98,000. Now let's check. Can we calculate the average stock? Come on, yes or no? Yes, we can calculate the average stock. You know how? Because just check, do you have the opening stock available? Yes, sir. We have the opening stock available, which is 40,000. Guys, if I have the opening stock available, then can I put it like this? That my average stock will be combination of opening plus closing divided by 2. So for 2016, what's my opening stock? It's 40,000. What's my closing stock? It is 60,000. So can I say this will now be 40 plus 60, which I need to divide it by 2. So this will now be 50,000. And here, my dear students, what is the first year's closing? That is going to be your next year's opening. So that is why the 60,000 is going to be your opening stock. And then we are going to add the closing stock, which is nothing but 94,000. So I will add 94,000 and then I will divide that by 2. So this will now be 60,000 plus 94,000, which I will divide it by 2. So that will be 77,000. Is this data sufficient for you to calculate your stock turnover ratio? Come on, yes or no? Yes, sir. So this will be 2,36,000 divided by 50,000. So that is 4.72 times. And this will now be 2,98,000 divided by 77,000. So this will be 3.87 times. So this will be your stock turnover ratio. Very simple, guys. I hope you have understood how do we calculate this. Okay, so from 2,36,000, I'll divide that by 50,000, and 2,98,000, I'll be dividing that by 77,000. So this is how we'll be getting the stock turnover ratio. Okay, I hope you have understood the difference. In the capital employed turnover ratio, we took the closing, not the average. And here in stock turnover ratio, we took the average. Why? Because opening was available. Very simple part. Okay. Then let's start with the sixth part. What's your sixth part? This is your net profit to net worth. Sixth part. Net profits to net worth. So what's the formula for the same? Net profits to net worth. So guys, net worth actually means your equity shareholder funds. So what is the meaning of the word net worth? Equity shareholder fund. So just present it to you like this. It is nothing but equity shareholders funds. Now, my dear students, This is indirectly nothing but return on equity shareholders funds they have asked you. What they have asked you, return on equity shareholders funds, because they have told you what is the net profits in comparison to the net worth. That is nothing but the funds invested. So it is net profits upon funds invested, right? So this is nothing but the return on equity shareholder funds. How do you calculate return on equity shareholders funds? So guys, your return on equity shareholder funds will be net profits for equity shareholders, divide that by equity shareholder funds into 100. And guys, I'm not going to use the word average here. Why I'm not going to use the word average? Because first of all, they have not told specifically that you have to calculate this returns based on your average. Second point, we don't have opening average for 2016. Guys, if I don't have the opening average for the year 2016, are we just going to take into consideration closing only? Come on, yes or no? Yes. So for the second year also, we are going to take into consideration closing. Okay. So that's why we will be having closing equity shareholders funds. So what is our net profits for equity shareholders funds? So chalo, what is the net profits for equity shareholders? So can I say all the profits which are there, it belongs to equity shareholders only, because there is no preference share capital in this question. If there is no preference share capital in this question, can I say all the profits belongs to equity shareholders? Come on, yes or no? Yes, sir. So in this particular case, we have the net profits available for equity shareholders. That is nothing but 15,000 rupees. Okay. So your net profits available here is 15,000. And here the net profits available for equity shareholders is 17,000. And then we have to divide that by closing equity shareholders funds. So that is nothing but share capital plus reserves and surplus. So this will now be 75,000 plus 25,000. Okay. There is no miscellaneous expenditure to the extent not written off. So this is going to be divided by 1 lakh into 100. And here, my dear students, will be taking 75 plus 42. 75 plus 42. So this will now be 1,17,000. So eventually, guys, what is this ratio? Can I say this is 15% and this is 14.53%? So is this your return on equity shareholders funds or your net profit to net worth? Come on, yes or no? Then the answer is absolutely yes. I hope my dear students will have understood this particular concept. That whenever we are calculating the returns, in calculation of returns, we need to check that how much is the profits, divide that by the amount of the investments. So we need to check the amount of the investments. The amount of the investments is closing your equity shareholders fund. So based on that, we have to do the calculation. Okay. Then the next part, which is your receivables collection period, your debtors collection period. Okay. So I have already explained this to you. Your seventh ratio, which is your debt collection period. Receivables means debtors only, na? So your debtors collection period. Now, my dear students, how do you calculate your debtors collection period? So I've discussed this with you. Whenever we are dealing with your debtors collection period or your debt collection period, we take 52, 365 or 12 and then we divide that by the debtors turnover ratio. Right? That's what we do it. So we take your 52, 365 or 12. And if no data is given to you, then the debt collection period should always be calculated in days. Okay. So we're going to take 365 and divide that by the debtors turnover ratio. So now you must be wondering, sir, where is the debtors turnover ratio? You have not told me there is debtors turnover ratio. It's okay, but we can calculate the debtors turnover ratio. Okay. So see, what is going to be the formula? So this is now going to be 365 and I will divide that by the debtors turnover ratio. Okay. Now guys, what is your debtors turnover ratio? Can I say this is 365, divide that by credit sales upon average debtors, right? This is your debtors turnover ratio. So if I take the average debtors here, I will get average debtors upon credit sales into 365. See, if I would have easily got my closing debtors, if that would have been available, then it was very easy for me to calculate it. If the debtors turnover ratio would have been given to me, then it would be very easy to calculate it. But unfortunately, we don't have the debtors turnover ratio, but it's okay. Do we have the average debtors? Come on, yes or no? Yes, sir. What is our average debtors? Average debtors is opening plus closing divided by 2. But my dear students, we don't have the opening debtors available for the year 2016. If we don't have the opening debtors for the year 2016, instead of average, I have to use closing debtors only. And that is because of standard measures of comparison. Because for 2016, if I take closing debtors, for 2017, if I take average debtors, how can I compare both these ratios? It's not possible. So my dear students, whenever we don't have the opening debtors available for the year 2016, then we are going to use closing. For second year, though the opening is available, but still I will use closing. For what reason? For standard measures of comparison. Right? We are going to do that for standard measures of comparison. So always and always remember this particular funda. That whenever we are going to do the calculation, it's always going to be closing debtors upon credit sales into 365. Now, my dear students, do we have the closing debtors? Because if for the first year opening was not available, I've taken closing. Do you have the closing debtors? Yes, sir. I do have the closing debtors. And what is the amount of the closing debtors? It's 50,000. So we have the receivables of 50,000. Okay, we have the receivables of 50,000. And to this 50,000, what am I going to do? I'll be dividing that by the credit sales. So do you have the credit sales? Of course, yes. We have the credit sales, which is 2,70,000. And I need to multiply that by 365. So this will now be 50,000. Divide that by 2,70,000 into 365. So that is 67.59, which is approximately 68 days. Okay, this is going to be a debt collection period. Also now at the same time, let's do it for 2017. For 2017, guys, do you have the credit sales available? Come on, yes or no? Yes, sir. I do have the credit sales available, which is 3,42,000. So I have this as 3,42,000. What is the closing debtors first of all? Closing debtors is 82,000. So 82,000 and to this 82,000, I'll be dividing that by 3,42,000 multiplied by 365. So this will now be 82,000. Divide that by 3,42,000. Multiply that by 365. So this will be nothing but 87.51, approximately 88 days. I hope you all are convinced with this much part. 68 days and 88 days. Now we are done with your seventh part, which is a debt collection period. Okay. And we have to give reasons for the change in the ratio. So we have to now do some analysis that what is the reason why there is some change in both the ratios. Okay, so we are going to now discuss that. Okay, and this is going to be super fun because analysis is very important. Okay, see guys, what is happening here in the first part? Just check. The gross profit ratio earlier was 21.33. Okay, gross profit ratio earlier was 21.33 and now it is 20.32. So what do you think has happened to the gross profit ratio? Has the gross profit ratio enhanced or it has reduced? It has reduced. Okay. And guys, whenever the gross profit ratio reduces, there are certain reasons for the same. What are the reasons because of which your gross profit ratio is reducing? Okay. Now see, I'll be writing down your analysis. Okay. I'll be writing down your analysis. And in this analysis, the first point is gross profit ratio is reduced from what to what, beta? It is reduced from 21.33 to 20.32. Okay, from 21.33 to 20.32. Now see, prima facie, there are two reasons due to which a GP ratio can be reduced. What are the two reasons because of which your GP ratio can be reduced? The two reasons are, First, if I increase the cost, the GP ratio will fall. Or second, if I reduce the selling price, the GP ratio will fall. Isn't it? There are two basically reasons for which the GP ratio can be reduced. One is if the cost increases, the GP will fall. Second is if if the selling price per unit reduces, the GP is going to fall. In this particular question, if you read it carefully, there is some information given to you regarding cost. Just check this out. They have told you in the question itself that the purchase price have remained stable during the concerned period. Guys, if the purchase price have remained stable during the concerned period, what does it mean? It means that the cost price has not enhanced. So what is the reason for the reduction of GP? Can I say it should be reduction in selling price per unit? So your GP has reduced because of what reason? It has been reduced because your selling price per unit has reduced. So this is something, my dear students, you have to understand it. Behind every information which is given to you in the question, there is some logic attached behind it. The purchase prices have remained stable during the consent period. Is there any objective? There is some logic attached behind it. Come on, yes or no? Yes. And it will help you to solve your analysis regarding why the GP has reduced. Okay. So in this particular case, GP ratio is reduced from 21.33 to 20.32%. Okay. So for that, we will write down there are two reasons due to which GP can fall. What are the two reasons due to which the GP can fall? So I will write down here increase in cost or reduction in selling price per unit. I hope you guys are trying to understand this. Increase in cost or reduction in selling price per unit. They have specifically told you that, sir, the cost is remaining stable. So here I will write down cost is stable. So automatically, this is not the reason. So can I say reduction in selling price per unit is the reason? Come on, yes or no? Yes, sir. So we will write down here, since cost remains stable, since cost remains stable, GP is reduced due to due to reduction in selling price per unit. Very simple. So this is going to be the reason. Tell the examiner that you know that there are two reasons because of which your GP can fall. One is increase in cost, second is reduction in selling price. And tell the examiner that you know that in this particular question the cost is stable. So that is why what is the reason behind reduction in the GP? That is your reduction in selling price. So this is your first analysis. Okay. Let's talk about the second. Now in the second part, my dear students, we have we have calculated operating expense to sales. Now see what is happening to the operating expense to sales. Can you see operating expense is 16.33, which has now reduced to 15.24. So has the operating expenses to sales reduced? Come on, yes or no? Yes, sir. And as you all can check, the operating expenses to sales has been reduced. It means that there has to be some impact on your operating profits. So is your operating profits increasing? Come on, yes or no? Yes, sir. As you all can check here, your operating profits has increased from 5% to 5.08%. So reduction in operating expense to sales, reduction in the operating expense ratio has a correlation with your operating profits. Come on, yes or no? Of course, yes. So your operating expense to sales is reducing and simultaneously your operating profit ratio is enhancing. So these two analysis, we can give it together. So we will write down here reduction in operating expense to sales ratio can be seen in enhancement of operating profit ratio. In bracket, you can write down from 5% to 5.08%. This represents increase in operating efficiency. See, my dear students, I want you all to solve, practice, write everything in front of me only. I could have given you this particular entire analysis part, by the way of notes, and I would have told you copy it from there. But no, I want you to build up this habit. Try solving it along with me. Write down all the analysis along with me. Develop that language. So it has to be your single stop solution for your financial management. Everything gets practiced here only in front of me. Okay. Third part. I know it's going to take more and more time for me only to complete it, but it's okay. We will, if we are doing it, we'll do it very, very, very thoroughly. The third thing which we have it is called as your operating profit. Fourth is your capital turnover ratio. Now, what is happening to the capital turnover ratio? See, your capital turnover ratio from 3 times, it is getting reduced to 2.54 times. So, can I say your capital turnover ratio is reducing? Now, whenever your capital turnover ratio reduces, we have discussed this, capital turnover ratio should always be higher, better. Why? Because we always want to generate more amount of sales with 1 rupee of capital employed. Isn't it? We always want the sales to be generated maximum on 1 rupee of capital employed. So here what is happening to the capital employed turnover ratio? Is it getting reduced? Come on, yes or no? Yes, sir. So this indicates efficiency or inefficiency. Answer is this indicates inefficiency. And you can also see whenever the turnover ratios fall now, those inefficiencies, you can also see it in your return ratios. Just check this out here. Are you able to check that your net profit to net worth is getting reduced? Everything is linked in finance. From 15%, can you see it's becoming 14.53? So if there is inefficiencies in your turnover ratios, where can you see the impact of it? The impact of it can be seen in the return ratios. Will the return ratios fall? Come on, yes or no? Then the answer is yes. From 15%, it has reduced to 14.53%. Superb. Clear? Are you guys trying to understand this? Okay. So there is a reduction from 15%, it has reduced to 14.53%. So my dear students, here in the analysis part, I will write down net profits to net worth is reducing due to inefficiencies in turnover ratios. Capital employed turnover ratio has reduced, indicating management inefficiency. Okay, this is your third analysis. What next do we have? Then, my dear students, we have the next part, which is going to be your stock turnover ratio. Acha, stock turnover ratio is also reduced. So, guys, this is not a good sign for you. Stock turnover ratio getting reduced is not a good sign for you. It means that your stock holding period is increasing. It means that now the money which is getting blocked in the form of stock is relatively higher. So that is why we will write down here stock turnover ratio has reduced, indicating increase in stock holding period. Now, my dear students, is it a good thing or it's a bad thing when your stock holding period increases? Of course, it's a bad thing. Why it's a bad thing? Because if you keep on increasing the stock holding period, it means that money is getting blocked more in the stock. It means that your cost is also going to be higher. So it's definitely not a good thing. Okay. So stock turnover ratio has reduced, indicating increase in stock holding period. Full stop, continue. This increases cost of investment in working capital. Because guys, you have to keep more amount of working capital. Next, fifth. What is fifth? Which analysis further is possible? The last one, which is debt collection period. Debt collection period has increased. So what does this indicate? This indicates efficient management, receivables management, or inefficient receivables. Answer is this indicates inefficient receivables management. Okay. But also guys, you can just check this out here, that what is happening to the credit sales. Okay. See, I have to be looking from the company's perspective also. See, this has increased from 68 days. This has increased from 68 days to 88 days. So from 68 days to 88 days, the debt collection period has increased. Okay. Now, when the debt collection period increases, in that particular case, what do you think is going to be the impact? See, the debt collection period increasing means what? That the money which is getting blocked in the debtors is for more period of time. I would like to simultaneously counter argue this as well. If the debt collection period is increasing and there is increase in credit sales, then is it justified that the collection period increased is considered good? Yes, it can be justified. You know why, my dear students? Because understand the concept like this, that whenever I want to increase the sales, what I can do in the market is I can enhance the credit period. If I keep on enhancing the credit period, then what happens? That can I say the debt collection period keeps on increasing, so more and more people will want to buy it from me. And if more and more people wants to buy it from me, then automatically, can I say my credit sales will rise? Come on, yes or no? The answer is yes, sir. Okay. So always remember this, that increase in your debt collection period, if it leads to increase in credit sales, then we can still justify it. Okay. So I will have to give both the opinions here. So we will write down like this. Receivables collection period or debtors collection period, if it is increased, then if it is increased, then it results in it results in inefficient management, full stop. The same can be justified. The same can be justified if we enhance, if we enhance the, if we enhance the credit sales. So we cannot blame the company here. We cannot blame the company, telling the company, listen, company, your receivables management is very. Then the company will tell me, okay, sir, my receivables management is bad. I agree to it. But also at the same time, my credit sales is also increasing, na sir. Then why are you telling me? My credit sales is also increasing, and that is, my credit sales is increasing because one of the reasons is I am actually having a higher credit period. So that is why my credit sales is increasing. So you cannot tell me that, okay, sir, you are doing bad only by increasing the credit period. So here the company also has a valid point. So we have to, balance both the things. Okay. We just can't be too much negative in life. Now with this, my dear students, we are done with your entire analysis, and your question number 2 is also completed. I hope you all have enjoyed this. Okay. Now we are going to start with the next question, and that is going to be our question number 3. Okay. So guys, let's get started now with question number 3. Now see, before we start with your question number 3, okay, I will just give you a small, uh, a small introduction about something which is called as basic accounting equation. Okay. So basic accounting equation, something which you're already aware about. You know what is basic accounting equation? When your total of assets is equal to total of liabilities. Okay, that's what you'll have learned. But here we are going to do it in a much better way. Okay, in financial way, and that is nothing but your total of assets, total of your sources of funds and application of funds. So how are we going to deal with that? Okay. So I just want you all to now focus properly your solution to question number 3. Before we start with that, I want you all to write down one note. And this note is your basic accounting equation. Okay. Basic accounting equation. Okay. Now, this basic accounting equation, how do we present it? So we present it by taking sources of funds is equal to application of funds. So actually, you know what is this? This is nothing but the entire balance sheet which we are presenting in one line. So that is nothing but sources of fund is equal to application of funds. Okay, so this is actually called as your basic accounting equation. Okay, your sources of fund is equal to your application of funds. Okay, now what are the sources of funds? So can I say that company can raise the money from shareholders? So shareholders funds can be your sources of funds. Plus, can I say the company can raise the funds by a way of debt, also long-term debt we are talking about. So long-term debt, these are the two main important sources of funds. And where do you apply those funds? So can I say we apply those funds in your fixed assets? Then we apply those funds in your long-term investments. And then, my dear students, we apply those funds in your working capital. So your sources of funds is equal to application of funds. So shareholders funds plus long-term debt, this is nothing but what? Where do we apply it? In fixed assets plus long-term investments plus working capital. Actually, this is nothing but the entire balance sheet presented in one line. If you just want to check, your balance sheet has how many things? It has equity share capital, right? Then it has preference share capital. It has reserves and surplus. It has long-term loans. It has creditors. It has bank overdraft. Then on the asset side, it has fixed assets. Then, which is nothing but plant and machinery, land and building. You know, then we have long-term investments that companies making investment somewhere else. Then we have stock, we have debtors, right? We have uh, prepaid expenses, and then we also have, let's say, miscellaneous expenditure not written off. So your balance sheet will look like this somehow. Okay. If I want to present this entire balance sheet in one particular line, then I use the concept of basic accounting equation, which is sources of funds that is equal to application. So whatever sources of funds are, we are going to apply it somewhere, right? So sources should be equal to your application. Okay. Now, if you all can just check, we have shareholders funds as the first part. So shareholders funds is what? The word is shareholder. So is it a general shareholder word? Come on, yes or no? Yes, sir. Does it include preference and equity both? Come on, yes or no? Yes, sir. So in your shareholders funds, we have equity share capital, we have preference share capital, we have reserves, and we subtract miscellaneous expenditure not at all. So all this put together is going to come in your shareholders. What is going to come in your long-term loans, your long-term debt? So long-term loans, debentures, etc. All these things are going to come there. So will bank overdraft come in long-term loans? The answer is no, because that is going to be your short-term debt and it will be forming part of your current liability. On the asset side, what do you have? Do you have fixed assets? Yes, we have plant and machinery, land and building, all these other fixed assets. Are we going to have long-term investments? Yes. And what is your working capital? Can I say current assets minus current liabilities? Will that give you your working capital? Come on, yes or no? Yes, sir. CA minus CL. CA minus CL. This will give you working capital. So, my dear students, this put together will actually be called as your basic accounting equation. Shareholder fund plus long-term debt. This is equal to fixed assets plus long-term investments plus working capital. Now, this basic equation, shareholder fund plus long-term loans, this is fixed assets plus long-term investments plus working capital, right? This is the basic accounting equation. By the way, this entire thing is called as your capital employed. What is it called as, beta? Capital employed. What is capital employed? The total money which is invested in the business. Now, my dear students, if no information is available, can I say we can assume the long-term loans to be zero? Can we assume long-term loans to be zero? Come on, yes or of course, yes, we can assume long-term because a company can operate without borrowing money, but a company cannot operate without shareholders' funds. So, in your sources of funds, among shareholders' funds and long-term loans, if no data is available, then can I assume my borrowed funds to be zero? Come on, yes or no? Of course, yes, I can assume the borrowed funds to be zero. And this is the application of funds. So, can a company operate without fixed assets? No. Can a company operate without working capital? No. But can a company operate without long-term investments? Of course, yes. So, without making investment in some other companies, can a company operate? Come on, yes or no? Of course, yes, we can operate. So, long-term investments, if no data is given to you, can we assume that to be zero? Come on, yes or no? Yes. So, what does it mean that if no data is given to you, we can consider shareholder fund is fixed assets plus working capital? Are you guys trying to understand this? Shareholders funds can be written as fixed assets plus working capital. So in the absence of data, I am just trying to make you understand that we can assume long-term loans and your long-term investments as zero to do further calculations. Okay. So my dear students, shareholders funds will be nothing but equal to fixed assets plus working capital. Okay. So this is a very short and precise formula for basic accounting equation in the absence of debt and in the absence of long-term investments. Are you guys trying to understand this? Okay. So shareholder funds is equal to fixed assets plus working capital. Now, if I tell you something like this, if I tell you that my proprietors funds, let's say like this, my uh, proprietors funds upon total assets, here they have given you a ratio. Okay, fixed assets to proprietors funds. Okay. Suppose your fixed assets to proprietors funds is, let's say for example, 0.4 is to 1. If they give you this kind of a ratio, fixed assets to proprietor fund is 0.4 is to 1. Now, what does this mean? For 1 rupee of proprietor, can I say my investment in fixed assets is 0.4, right? So, 1 rupees proprietor fund which is coming, proprietor are whom? Proprietor are nothing but shareholders, right? So, my shareholders, 1 rupee if suppose is blocked by shareholder, in my fixed assets, there is 0.4. So, can I put it like this? My shareholder fund is 1. In my fixed asset is 0.4. So what about the balance 0.6? Can I say my balance 0.6 is nothing but my investment in working capital? Come on, yes or no? Answer is absolutely yes, sir. So what I'm trying to make you understand is that sometimes they will just give you this kind of a ratio. They will give you like this: fixed assets to proprietor fund is 0.4 is to 1 or 0.7 is to 1. But then we have to understand this, that if no data is available, then we assume that there is no borrowed funds, there is no investment in your long-term investments. So automatically that 1 rupee of shareholder fund, if 40% is going in the fixed assets, then obviously where is the balance 60% going? Can I say the balance 60% will go to your working capital? Come on, yes or no? Absolutely yes, sir. Okay. Now, how will this help you? So this is nothing but basic accounting equation, which is going to help you in this next question. Okay. So I want you all to please come to your question number 3. Okay. Now see what is given. The following information relates to X Limited for the year ended 31st March 2020. We have the net working capital amount, which is nothing but 12 lakhs. We have fixed assets to proprietors funds, that is 0.75. Okay, so this is nothing but fixed assets upon proprietors funds, which is 0.75. Working capital turnover ratio is given to you as 5 times, and we have the ROE available as 15%. Now, based on this data, what you need to do, you are required to calculate what is going to be the proprietors funds, fixed assets, and net profit ratio. These are the 3 things we need to calculate. Okay. So, solution now to my question number 3. Okay. What is asked first? You are required to calculate proprietors funds. Now, I can present it like this. As per basic accounting equation, sources of funds is equal to application of funds. So what are the sources? I have shareholder funds plus borrowed funds. This is equal to fixed assets plus long-term investments plus working capital. If no data is given to you, I can assume borrowed funds to be nil. If no data is given to you, I can assume long-term investments to be nil. So that's why this will now be shareholder funds is equal to fixed assets plus working capital. All right. Now, what is this ratio? As you all can check, this ratio is nothing but 0.75 is to 1, right? So your fixed assets to shareholder funds is nothing but 0.75 is to 1. What does this mean? For every 1 rupee of shareholder funds, 0.75 is blocked in the form of fixed assets. So for 1 rupee of shareholder funds, 0.75 is blocked in the form of your fixed assets. Can I say this data is sufficient for you to calculate what is going to be your working capital ratio? Come on, yes or no? Of course, yes. So we can present it like this. Shareholder fund is fixed assets plus working capital. What is your shareholder fund? 1 rupee. What is my fixed assets? 0.75. So automatically let the working capital be 0.25. Do I have the amount of working capital? Yes, sir. I do have the amount of working capital. What's the amount of working capital which I have? That is nothing but 12 lakh rupees. So if I have this as 12 lakh rupees, can I calculate my shareholders funds? Of course, yes, I can calculate. So what's my shareholders funds going to be? I have to cross multiply. If 0.25 is 12 lakhs, so 1 is how much? So this will now be 12 lakh into 1. Divide that by 0.25. So 12 lakh, I will divide that by 0.25. So this will be 48 lakhs. So do I have the proprietors funds? Come on, yes or no? Yes, sir. So this is proprietors funds, which is 48 lakhs. So what is now going to be my second part? My part B is, okay, boss, what is going to be my fixed assets? Oh, hello. This fixed assets also can be calculated very easy. How can we calculate this fixed assets? So this fixed assets can be calculated by taking whatever is this basic accounting equation, shareholder fund is equal to fixed assets plus working capital. So we have the shareholders funds as 48 lakhs. Let the fixed assets be X. So automatically your working capital amount is 12 lakhs. So what is going to be your amount of fixed assets? So from 48, if I subtract 12, what do I get? I'll be getting 36 lakhs. So is my fixed assets going to be 36 lakhs? Come on, yes or no? Absolutely yes, sir. My fixed assets will be 36 lakhs. So are you understanding how much is this basic accounting equation going to help you? In this basic accounting equation, we are simply and simply going to check What is going to be my shareholders funds? What is fixed assets? What is working capital? We have the shareholders funds. Let the fixed assets be X. We have the amount of working capital. Then we can calculate it accordingly. And we'll be getting this as 36 lakh rupees. Okay, guys? Fine. Now let's continue further. C part. What is your C part? Net profit ratio. Now, what is the formula for net profit ratio? As you all are aware, it is nothing but NPAT upon sales into 100. Is this the formula for net profit ratio? Come on, yes or no? Yes, sir. NPAT upon sales into 100. But my dear students, as you all can check, we have working capital turnover ratio is 5 times. So my working capital turnover ratio is nothing but sales upon working capital. This ratio is 5 times. Okay. They have given to you working capital turnover ratio is 5 times. And let the sales be X because I have the amount of working capital which is 12 lakhs. So now my dear students, definitely I can calculate the amount of sales. My sales will now be rupees 60 lakhs. So do I have the amount of the sales available? Yes, sir, which is nothing but 60 lakhs. And what is the amount of net profits after tax? So for that, they have told you there is ROE given to you. There is return on equity which is available. So how will you calculate your return on equity? So guys, your return on equity, what's the formula for return on equity? Return on equity is nothing but net profits for equity shareholders. Divide that by equity shareholders funds into 100. So what is your ROE percentage given to you? 15%. So let this be 15. Let the net profit for equity shareholders be X. And guys, what about your equity shareholders funds? Can I conclude like this that all the shareholders funds belong to equity shareholders only because there is no preference share capital in the question? In the absence of preference share capital, can I say shareholders funds itself is your equity shareholder funds? So there is no need to worry. Guys, do you have that shareholders funds amount available? Yes or no? Yes, sir. So this 48 lakh rupees, this is nothing but your equity shareholders fund because there is no preference shares. So all the shareholders is nothing but your equity shareholders. So I can write down here 48 lakhs and multiply that by. So now this will give me net profits for equity shareholders and this will be 48 lakhs into 15, divide that by 100. So that will be 7 lakh 20,000. So guys, I have this as 7 lakh 20. This is 60 lakhs. So 7 lakh 20 divide by 60 lakhs into 100. Is this 12% your net profit ratio? Come on, yes or no? Then the answer is absolutely yes. Your net profit ratio is 12%. Have you guys understood this? So very easily we have calculated. We have understood that we need, first we always write down the ratio. Net profit ratio. What's the ratio? First, always write it down. Net profit ratio is NPAT upon sales into 100. Always first write down the ratio. The second part is then check whether we have the data or not. No, we don't have NPAT. We don't have sales. But don't worry. We don't have NPAT. We don't have sales. But at least we have, my dear students, what is going to be your working capital turnover ratio? This will actually help you to calculate the amount of sales. So your working capital turnover ratio, we are going to get the amount of the sales, which is 60 lakhs. We have the ROE percentage available on the basis of which we get the net profits for equity shareholders, and all the profits belongs to equity shareholders only. Okay, because there is no preference share capital in this question, and eventually you'll be getting this as 12%. Awesome. Hi Adarsh, how are you, beta? Have you all understood this? What we have done? Okay, fine. So now with this, we are done with your question number 3. That is also completed. Okay, sure. Now let's continue further. And we have time to at least complete one more question. Okay, so let us do your question number 5. Okay, let's read this. X has made plans for the next year. X has made plans. I'm really very afraid when X makes plans. Okay, so X is making plans for the next year. Don't follow, okay, whatever your are your X's plans. But here in this question, we have to take this into consideration. So what is given to you? We have, it is estimated that the company will employ total assets of rupees 8 lakhs and 50% of the assets is being financed by borrowed capital at an interest cost of capital of 8%. And also at the same time, the direct cost for the year are estimated to be 4,80,000 and all the other operating expenses are estimated to be 80,000. The goods will be sold at 150% of direct cost and the tax rate is nothing but 50%. We are required to calculate operating profit margin before tax, net profit margin before tax, return on assets, that is on operating profits after tax, and asset turnover ratio, and your returns on equity. So this is something which we need to calculate. Okay. So guys, first of all, in this question, we have to calculate these many ratios. So what should be your first step? Your first step is we have to prepare the income statement. The moment we prepare the income statement, we come to know, okay, these all are your income statements. These all are your figures. And then we can calculate the ratios based on that. Okay. So let's do this together. Adarsh Sharma, let us now start with your solution to question number 5. You can write down your income statement. And in this income statement, how will we solve? First item we are going to write down will be nothing but your amount of sales. Do you have sales, sales? Okay, we'll write down your sales. Then they have told you from sales we are subtracting direct cost. Don't worry, beta. Direct cost is nothing but the cost which comes on your trading account debit side, right? This is nothing but your uh, purchases, freight inward. All these are called as a direct cost. Okay. So sales minus direct cost, this will definitely give you your gross profits, from which we then subtract indirect cost, which are appearing part of your P&L. So I will term this as operating expenses. Okay. Ultimately, what will we get? We will get here as your operating profits, and these operating profits are also called as your EBIT. Then from this we subtract your interest. What do we get? We get EBT. Then we subtract your tax. I don't think there is tax rate given to you. Is it given? Yes, tax is given. So tax at the rate of 50% is given to you. Ultimately, we'll be getting NP80. And guys, if there is no preference share capital given to you in the question, then guys, all the profits belongs to whom? Can I say all the profits will belong to your equity shareholders? Come on, yes or no? Yes, sir. So this NPAT, all the profits belongs to your equity shareholders. Okay, so all the profits will belong to your equity shareholders if there is no preference share capital which is given. Now you guys can just check what do we have here. Guys, in this particular question, first of all, let us write down the figures which are readily available. So which figures are readily available? So we have the direct cost which are estimated to be 4,80,000. Okay, no problem. So we have direct cost as 4,80,000. So we can write down here. Then they have also told us that all the operating expenses are estimated to be 80,000. So all other operating expenses are going to be 80,000. So we are fine with this also. And the goods will be sold to our customers at 150% of the direct cost. Okay, no problem. We can calculate the amount of the sales. Now, why am I shouting that we can calculate the amount of the sales? Because goods can be sold at, what have they told you? 150% of the direct cost. So simply take on your calcis 4,80,000 and add 150%. Sorry, add your 50% to it, because Goods are sold to customers at 150% of the direct cost. So 4 lakh 80 plus 50%, that will give you 7 lakh 20. So guys, it is something like this. If this is 100 now, then it is sold at 150%. Matlab it is sold at 150 of the direct cost. So that is why this will be 7 lakh 20. To this we are going to subtract now 4 lakh 20, 4 lakh 80, sorry. So this is 2 lakh 40, from which we'll be subtracting 1 lakh 80,000, sorry. So this will be 1 lakh 60. What's your amount of interest? So your interest is, we are taking the loan of 8 lakhs. Total assets is 8 lakhs, out of which 50% is financed by borrowed capital at an interest rate of 8%. So let us put it like this. We have total assets of 8 lakhs. And from this total assets of 8 lakhs, we have 50% which is being financed by borrowed capital. So there is debt. And your 50% is going to be your shareholders fund. So 4 lakh is going to be your debt. And what's the rate of interest? The rate of interest here is 8%. So 4 lakhs, multiply that by 8%. So that is 32,000. So this will now be 1 lakh 28,000. The tax rate is 50%. So that is 64,000. So your net profit for equity shareholders will also be 64. So this is going to be your entire income statement. Okay. So we will be finally having your net profit for equity shareholders as your 64,000. And now this will make our question very, 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 very simple. Okay. So what are we going to do next? We will be taking into consideration the first ratio, which is your operating profit margin ratio before tax. So basically we are required to calculate your operating profit ratio. Operating profit ratio we always calculated before tax only, which was nothing but, if you all can recollect, EBIT upon sales into 100, right? So the first ratio which we have is your operating profit ratio. So now we can write down here first ratio, operating profit ratio. And what is going to be the formula for operating profit ratio? It is EBIT upon sales into 100. Do we have the amount of EBIT? Yes, sir. We have the amount of EBIT. What is the amount of the EBIT which we have? 1 lakh 60. So it is 1 lakh 60. Do we have the amount of sales? Yes, sir. What is the amount of sales? Amount of sales is 7 lakh 20. So 1 lakh 60 upon 7 lakh 20. So what is this ratio going to be? 1 lakh 60 divided by 7 lakh 20 into 100. So this is now going to be 22.22%. So this is your operating profit ratio, 22.22%. Then what is the second ratio which you have? The second ratio which we have is your net profit margin. Oh, net profit ratio. Net profit ratio is always after tax, beta. So your net profit ratio will now be NPAT upon sales into 100. So guys, do you have NPAT? Yes, sir. We do have NPAT. What is the amount of the NPAT? Just check. 64,000. Do we have the amount of the sales? Yes, sir. We do have the amount of the sales, which is 7,20,000. So now the guys, we just have to do the formality of substituting the figures. Okay, so this will now be 64,000. Divide that by 7,20,000 into 100. So that is 8.89%. And then, my dear students, we have the third ratio. What is your third ratio? Your third ratio is going to be return on assets. Okay. So return on assets, and what they have specifically told you. See, they have told you that it is on operating profits after tax. So what will be the formula? Operating profits is EBIT, but they have told you we have to take operating profits after tax. So that will be EBIT into 1 minus tax upon sales into 100. So it's EBIT into 1 minus tax upon sales into 100. Is this going to give you a return on assets? Come on, yes or no? Yes, sir. So what's the amount of EBIT? So your amount of EBIT, which you just now you have calculated, that is 1,60,000. What is the tax rate? 50%. So 1 minus 0.5. Your sales is 7,20,000 into 100. So this will now be 80,000 divided by 7,20,000 into 100. So that's going to be 11.11%. So this is going to be your return on your assets, 11.11%. Same concept, guys. We have to take EBIT post tax and then we have to divide that by sales and multiply it by 100. This will give you 11.11%. What else do you have next? Your fourth ratio. You have your fourth ratio as asset turnover ratio. So your asset turnover ratio will be sales upon, we generally write on average assets, but here we have to write down closing assets only. Why? Because there is no opening data given. So if no opening data is given to you, can I say we have to stick to your closing assets only? Come on, yes or no? Yes, sir. What is the amount of sales we have? The amount of the sales which we have is nothing but 7,20,000. What is the amount of the assets which we have? The amount of the assets which we have is nothing but 8 lakhs. So this ratio is going to be 0.9 times 7 lakh 20 divided by 8 lakhs. So this is going to be 0.9 times. And then, my dear students, let us start with the next ratio. So your fifth ratio, what is that? Your return on owner's equity. So what is your return on owner's equity? It means your return on equity shareholder funds. So how do you calculate this? So this will now be net profits for equity shareholders, which I need to divide it by equity shareholder funds into 100. Normal calculation, net profits for equity shareholders, divide that by equity shareholders funds into 100. So what is your net profits for equity shareholders? Because there is no preference shares, can I say all the profits belongs to equity shareholders? That's 64,000. So we will take 64,000 and we are going to divide that by equity shareholders funds, and that is 4 lakhs. So how much is this going to be? 64,000 divided by 4 lakhs into 100. So that's 16% for you. So this is your return on owner's equity. So I hope, guys, you all have understood this. We have solved all these ratios. Okay, what is the approach to solve the question? If you are liking this particular videos, please like, comment, share, so that it gives us more motivation to spread these good videos to more students who are pursuing CA, and they all can take the benefit out of it. Okay. So with this, my dear students, now we are done with your fifth question as well. I hope you all have enjoyed what we have done today. Wish you all the best.